Welcome to the ETF Think Tank. I'm Dan Weiskopf. It is September 28th, 2023. I'm also known as the ETF Professor, lead ETF strategist for the ETF Think Tank, and co-portfolio manager with Mr. Venuto on the largest blockchain fund. So I'm a busy beaver. So with that, I'm going to hand off the mic to Mr. David. Go for it.
It's been everyone, Mr. David here, fellow portfolio manager amongst the Title Financial Group here. I've been with the company for about 10 years and very excited to talk about all things trend with Jerry Parker, and I'll pass it along to our favorite colleague, Cynthia Murphy.
She's our favorite.
Hey, everybody. Cynthia Murphy, head of research for the ETF Think Tank. We have a great show today, great guests. We're very excited about it. Mike, you introduce yourself and then pass it on to Jerry.
Okay, Mike Venuto, co-founder, CIO of Title Financial Group, where we help others launch and grow ETFs. I never thought I'd get the honor to do that with Mr. Jerry Parker, but we have. I put a link to his new fund that he did with us in the chat. Our word today is going to be trend. If anyone knows Jerry's work, you'll understand how often we'll be saying that. As usual, if you want to ask a question, put it in Q&A. If you want to be promoted up to a panelist, come join us at the Think Tank bar. We'd love to have you up here. Just ping me, and then we'll get you in to ask questions towards the second half of the show. So with that, Jerry, would you mind introducing yourself?
Not at all. Thanks for having me. Jerry Parker, chairman, founder, Chesapeake Capital, 1988. It's been a long time, long journey. I got started in 1983, so I'm the oldest person here, I'm pretty sure. So just turned 66 yesterday. So I'm glad, but also I'm wondering where all those years went. But we're known for trend following plus nothing, trend following everything under the sun we can find. We like to use trend following, go long and short, and do it with nothing but more of a classic approach to trend following, which allows you to let those profits run, but also give back those profits, unfortunately, sometimes.
Okay. So I know my team here has a million questions for you, but I wanted to start a little bit about that history. So you said you started in 1983. The idea of actively managing commodities as an investment pool, as a CTA, CPO, as a trend follower really wasn't a thing yet, right? It was mostly desks doing it for themselves. How did this all come about and culminate in launching an ETF that does trend following on both equities and commodities in one pool, which also wasn't thought could be done, call it a year ago? So tell us the origin story and how we ended up here.
Well, I went to work for Richard Dennis in 1983, and I taught me how to trade and trend following, and there was a big emphasis on trading as many markets as possible for trend following to succeed and do better than it for it to do as well as it could. You needed to really concentrate on trading a lot of markets, and so that's sort of what we've done over all these years is continue to try to keep a pretty consistent basic trend following system, but continue to add markets, more commodities as those markets have grown, and more bond markets, currency markets. But obviously, if you really want to start going crazy and adding lots of markets and getting massive and maximum diversification, you're going to be looking at the stock market. So I've been a big proponent of forgetting about managed futures or commodities and the traditional markets that one would think you were going to use for trend following in CTAs, but expand that and make trend following the number one thing to concern yourself with, and making that as good as it can be. And so getting into the stock market and trading a lot of stocks, long and short, and trying to increase the diversification of the portfolio with equities has been on my mind for over 20 years. So obviously getting it to this level with an ETF and making it available for lots and lots of people in this wonderful wrapper that people just love is really something we got really excited about, and really excited that we were able to do it and pull it off. And because from day one, people were telling us, I mean, I remember the first conversation we had. I told you about a conversation I had with a mutual friend, and he said, "This can't be done. I don't know why Title told you could do it."
Yeah, I mean, just everybody. So the mutual friend is also our closest competitor, as Wes at Alpha Architect. And the truth is, this couldn't have been done 3 years ago because we didn't have the derivative rule, right? The second reason this was really hard to do is you have to find a market maker that can make markets in multi-asset classes and then put them into a system and actually come up with a good and fair spread. So it was really, really hard to do, right? It was about a year that you guys were out there trying to do this before you met our Gavin, our guy who does our capital markets. But that was the key component that I think got this over the line, if I remember correctly.
Right. And it's such a unique product. It doesn't exist really. And we kind of like, I mean, it's kind of, I'm going to get in trouble, but it's a little bit, our goal was not crisis alpha, not how does CTAs fit into your 60/40 and adds value, but it was more like the perfect portfolio. How do we make the portfolio better? And rather than trying to add and manage futures to the traditional portfolio, we were like, why not add trend following into the stocks and help those? You know, it's, in my opinion, because it's my lifelong pursuit, this trend following silliness, as you know, everything, I just believe totally everything needs a trailing stop, everything needs a stop loss. And it was about time someone, you know, took it seriously and provided this product for people you can trend follow equities as well. So it's just what I think people get sick of me talking about it. But I did hear the other day on another podcast, a friend of mine that I know, and I was on his podcast, and he actually said, I'm not sure if Jerry trades single stocks or not. So even though I think I talk about it all the time, not everybody can remember, I guess.
All right, Dan, all yours.
Yeah. So let's go high level. And everybody seems to be focused on the Treasury these days, right? And listen, we've been in a long-term trend on the Treasury for 30 some odd years, right? I see that you're not long duration in the Treasury, but you are long high yield. What are your thoughts on, I don't know if you actually have opinions on credit crisis so much as if a credit crisis were to occur, you know, what is your positioning under that scenario?
Well, my positioning under every scenario is just to go with the trend and try to have a portfolio that's very diverse. So you're right, on the interest rate futures markets, we're pretty short across the board. They're all in downtrends. We trade a few ETFs, corporate bonds, tips. But some of the things that we sort of put in that category, interest rate ETFs, like high yield, they tend to be more, you know, equity related. So it's kind of a hybrid, I guess. And then we're close to going long some other interest rates. Let's say we have been over the past 6 months here and there a little bit long. That's one of the benefits of trend following, is that when you overlay trend following to these markets, you can switch your positions around a bit and gain some diversification. Even though the correlations might be very high, it is possible. I know at one point we were long some Italian bonds, you know, just for a few weeks or a few months. But the trend following adds a piece of diversification to all these markets as well, because the pattern just has to change slightly, and oops, you're long all of a sudden, and everything else may be short. And so this product, you know, our strategy really tries to maximize the amount of diversification that the clients are going to get from the markets and from the different, we trade multiple trend following systems with different entries and exits.
First off, we all owe about 20 drinks because there are a lot of tons in there. So that's back up here.
I already need a refill at this pace. I'm not going to make it much farther.
Yeah.
Jared,
I went with water today, so I'm being very careful.
Fancy water as well. Can Can you give us some thoughts on like the top-down structure? Is there like a maximum volatility target? And then also you mentioned trend, and I know you're primarily looking at like a longer term period, maybe 1 year, but what does trend mean to you? And when might it mean different things or different time periods?
Well, I think the most important thing to remember is it's a systematic approach, and it's going to be based upon some computer research and back testing. And we just want to use approaches and systems and metrics and parameters that make the most amount of money historically, and use a handful of those, not just one set of parameters. And so then when you look at that and look at those numbers and do those back tests, you sort of see that, okay, yeah, one way to describe it is going with the trend and being a trend follower. But I don't like to sort of think in those terms. It's because sometimes you can look at a chart and say, wow, Chesapeake is still long. Oh, the euro. Someone mentioned that the other day, like, how are you still long the euro? And so, yeah, it kind of looks like that uptrend has been over for a while. And so it's, but the computer, some of the analysis we do, it says, hey, look, you make more money if you just hang into these trends longer. And so that's what we do. I don't really want to look at the trend per se and make a decision, because sometimes I look at our positions and I say, yeah, my own human instinct would say the trend is kind of over. But as I said earlier, a lot of times when it looks like it's over, it has this amazing rebound. And if those amazing rebounds weren't in the data, we wouldn't trade as long term. We're just purely driven by the data. And one of the other things that data sort of tells you is the more amount of pain and suffering that you're willing to put up with, the more money you're going to make. So, the cliche of letting profits run, that can get very painful sometimes because you built up all this profit. Cocoa, we long cocoa, and it's been crashing a bit the past week. And so, but we're still not even close to getting out. So it's probably not unbelievable to think that if you look at the data, being willing to put up with the ability to give back material amounts of big profits allows you to stay in the big trends longer and make more money overall, not maybe in this particular trade or this particular week or month, but overall, you're going to do better the more you're willing to sort of just let the profits run, do what they're going to do, and accept a fair amount of volatility.
And to that point, you're looking across different asset classes with that thesis, and you're sizing your risk on an individual basis, frankly, I think pretty small, right? So when something's not going your way, it's not going to blow you up unless you're overweight that asset class. Am I getting it right? And by the way, just so everybody's aware, you're also on the short side too.
That's right. So because we trade so many markets, over 300 markets, and we have a fairly healthy stop loss. We're not close to the market. We're not going to get whipsawed around. We have, I wouldn't say a small loss. It's more of an optimal loss. What's the optimal amount of loss you should take per trade? So on every trade, when we hit that level, the loss is going to be around 12 basis points. So it's really small. And now if it's a profitable trade, we'll lose a lot more than that, 100 basis points, in a trade that if it's a profit. So that's the trend following mentality. If it's a losing trade, I'm very afraid, I'm very cowardly, I'm going to get out of my losses, I'm not going to let it turn into something big. And if it's a winning trade, I'm going to let it run. I'm going to give it a lot of room, give it every chance to turn into something big. And just based upon those two factors. So we're really good at preserving capital because our hit rate is only about 40%, but the losses are really, really small. And we're really good at capturing the trends because we're in every single one of them. We don't let any trend get away from us. Where we tend to look not great all the time is, giving back the profits. Clients get really uncomfortable with giving back the profits. Everyone wants to nail it down. We made this money, let's don't give it back. But so often we're about halfway or a third of the way up with a lot more to go. And then you're never going to do very well if you let your emotions rule you. And so sticking with the systematic rules-based process is going to work overall. Not, like I said, not on every trade, not on the trades. And look, what trades matter? I tell you which ones matter. Today's trades, they matter. But you've got to get that out of your head and realize that the long term matters. The next year or two or three, and doing the right thing on all those trades, you're going to be much more happy in the long term than making sure you don't give back too much profit on one individual trade. We just have way too many other trades to worry about. And so it's really nice, and it helps you sleep at night, not having one position or even a group of trades. It can really hurt you too bad.
You have half your risk budget coming from equities, and this was an example you walked us through before the call that I thought was very helpful in understanding how this strategy operates. And over the last couple months, obviously with the drawdown in equity markets, you've seen a drawdown on the long side of your equity and then increase on the short side of your equity. Can you talk about how that works within your portfolio and how it floats amongst different market cycles, et cetera?
Right. So the first thing we do from day one is choose the portfolio. And we want this really great diversified portfolio, currencies, all the currencies you could possibly think of. We trade them all. It's a lot. Commodities, we trade them all, maybe except China. Then all the interest rates, and more than most people, because we get into the ETFs, some of the ETFs that don't have futures, we trade those as well. And then stocks. And so stocks is a really difficult situation for people because there's so many of them, and you have to make some choices and you have to do some analysis. And so we want to have this stock portfolio that's incredibly diversified, lots of different types of companies, a lot of commodity-based companies. And so we pretty much just, once we set the portfolio, we just trade each individual trade on all the stocks, each individual market with this set of rules. And the portfolio itself doesn't really take into consideration anything that's happening with any of the other markets or the current equity or the drawdown or the current profits. It's just strictly going to do every single trade based upon this system that we have. And so if you see a rotation in the stocks where we go from longs to shorts, it's just because the trends are changing. And like right now, we have a lot of shorts and a lot of longs, a few more longs than shorts, but we're really heavy in the stocks. From our point of view, we're like really, really heavy, but you brought up a good point, like netting it out, we're barely long. But as you know, we've seen situations where, unfortunately, our longs go up and our shorts go down. Our shorts go down, our longs go down and our shorts go up. So even the best laid plans for all this diversification, longs and shorts, doesn't always work perfectly like you want it to. So you asked me a question about risk a few minutes ago and I forgot about it, but I think that's the most important decision a manager needs to make, especially a manager like us who has so much access to leverage and we can completely choose how much risk we want to take on. That initial choice of leverage needs to be something you're very comfortable with, and that's not going to get you in trouble later on. You don't want to get into a situation where you're trading large, and instead of risking 12 basis points per trade, you risk 25 or 50. And then you're going to scramble later to get rid of some of that risk because the markets are changing, and you need to override your systems with some heavy-handed risk control and position reduction. You don't really want to do that. You're a systematic trend follower. You want to be disciplined. And part of being disciplined is setting up your portfolio and your system so you're able to take every trade. You're going to win if you just follow the rules or you're able to take the trades. And so often we think, well, I'm going to take those trades. Yeah, you're going to take them, but sometimes if you don't have your risk under control, you're not able to take them. You're too risky and you need to start cutting back. So that plays into your ability to be disciplined and follow the rules. And So it's something that we pay a lot of attention to, and we haven't always done that. I remember back in 1983, I asked Richard Dennis, what are the most important things about trading? And he said, one is following your rules, and the other one is trading small. And every situation I've ever gotten in those 39 years since then, it's all because I traded too large. But now, not now. I've changed. So a lot of experience.
So I've got two questions. I think your portfolio holdings is now about 300. How large, or what's the range in that context? And then a follow-up question. I've got a follow-up question. I don't want to confuse you with the first question now.
See here. I think, were you asking me how many markets I can trade eventually?
No, just roughly. Just like a broad range. Bloomberg's got you holding 307 positions.
Right.
I mean, so maybe it ranges 250 to 500. I don't know.
50. So, there are CTAs out there that trade 500. What I think is a good idea for us is to maintain the 50% stocks. So we're good right now because we have about 160 other markets, currencies, commodities, and interest rates. And so we could be we could go a little over 300 to match those. I think a 50-50 blend is pretty good. If all of a sudden more markets come on board in the currencies or the commodities, then we'll add a few more stocks, But there are some people out there, that trade the China market, China futures, and over-the-counter stuff. I think we prefer to stick with liquid exchange traded as we do now, but we're not number one in the number of markets category, but 300 is a very nice number. But I would guess 400 in the next 3 or 4 years, probably, as the markets, things change, things evolve, they come out with new markets. I hope it continues.
And then I was personally very pleased to see some familiar names in your portfolio that are also in our portfolio. But frankly, I was surprised that they were capturing an uptrend, according to you. And so I asked the question, how early are you with your initial position in telegraphing a trend?
Right. So we trade about 4 different strategies. Well, just different. They're all trend following, but the 4 different entries, 4 different exits, different time, So maybe something like, we don't trade this, but it would be something like the 100-day high. So if a market made a 100-day high, that might be system 1, So you go long at the 100-day high, go short at the 100-day low. And it would look something similar to that. We don't exactly trade that parameter, but it would be something similar to that. So look, if the 100-day high doesn't look like the start of a new trend, so be it. And sometimes the 100-day high looks like, why did you wait so long? This market's been trending for a while. It doesn't. That's what I was saying earlier. Following a systematic approach, this 100-day breakout entry exit, that works. It makes lots of money. If someone says to you, describe how you trade, you could say, yeah, it's kind of trend following. But as I said earlier, it doesn't always look like it's trend following. Waiting for the 100-day low sometimes in cocoa, like right now, that's absurd. I hope that doesn't happen. I would be giving back too much profit, but that's just the way we approach it. Sometimes it's not going to work out, and then sometimes it does. One of the characteristics of the markets these days is they're very choppy, and you get these big trends, but they're very violent corrections. And we just hang in there. We stay in there, and we don't get shaken out, because that's the death if we don't make money when it's available. And we just got to cross our fingers that we'll continue to do okay on the exits. But some of the exits we do give back quite a bit, and some we don't. It's really a situation of just having done this for so long and just not being freaked out by it, because it does freak out everybody. Really, the clients really dislike it. they'd really dislike giving back profits. People think that once they have an open profit, it belongs to them and it's theirs and you should not lose it. But being willing to lose it is a superpower. You will make so much money and you'll be a very lonely person because there's not many people who are going to hang into those trends as long as we will.
I think it's
Dave,
super interesting.
jump in or
Yeah, no.
I wanted to clarify Dan's thing, but you go ahead first. Go ahead.
You can go if it's on topic, Mike. Go for it.
Yeah, I mean, I want to, like, what Dan is really getting at is you put a trend following strategy around a kind of a new asset class, which is the concept of blockchain or crypto stocks. There's so much news right now and chatter on Twitter about an Ethereum futures ETF coming out any day. You've been trading this stuff since we launched, and it's just because it's not about an Ethereum fund, right? It's about the trend in that area. So it's amazing to me, like, how the talking heads don't pick up on it, right? Like, now, like, I helped write the prospectus. I know we were allowed to do this stuff. So, and the SEC doesn't see it as an Ethereum fund. They see it as a large trend following fund with 317 or 7 positions. But I love that there's this new asset class that you're trying to put trend to. I would love you just to talk to that just a little bit, because I know that's where Dan was going. I know, David, you've got another question, but I want to hit on this crypto blockchain trend following strategy as kind of a new sector within the portfolio.
Oh, yeah. Sorry, Dan. I'm not good at taking hints sometimes. So we are trying to carve out this fifth sector of blockchain crypto. And it just depends, on how many markets are out there and the diversification you're going to get and the liquidity. So right now it's just the 2 futures contracts with Ethereum and Bitcoin. We love them. I mean, they're perfect for trend followers. You say to your clients, we don't pay attention to fundamentals. All we do is pay attention to the trends. Look, no one even knows the fundamentals of these of Bitcoin. You can't even pretend to know it. It's the perfect market for trend following. And all us old guys, we didn't even have a clue how to set up an account to buy Bitcoin, But as soon as they come out with a futures contract, I mean, we're all over that. We've been doing futures since the 80s. And so I thought it was just wonderful, and I couldn't wait to trade it. I'm so happy that they were liquid. And then recently I think we have about 8 to 10 stocks in the same category that, according to us, we think are correlated to, are okay to be in that category of blockchain crypto. And we hope we can add more, and that becomes a really big part of our portfolio, maybe, hopefully 30, 40 markets, and it will be a legitimate fifth sector. But, I do think that, honestly, from my point of view, I would like it a lot more if it was less correlated, a bit less correlated. They seem to be a tad correlated. But that's another thing that we sort of buck the trend on as well. Drink up. We tend to look at correlation a bit different than most people. We trade Brent and WTI and heating oil and crude, heating oil and unleaded. So I think there's 2 kinds of diversification. One is the daily portfolio volatility. We want to keep that kind of low and as best as it can be. And with 300 markets, we're good at doing that. But another thing that happens too is, even in markets that are highly correlated, you can have much different performance. There's been a few times in my career where heating oil doubled and crude kind of sat there. My whole year was made in 1990 on heating oil. And so you can have 2 markets like that or more that are really highly correlated most of the time, but some crazy event happens and it affects one and not the other. They remain pretty correlated. Silver in 1987 went up a ton more than gold. And so you miss these outliers if you pay too much attention to the correlations and eliminate one of them or scale one of them back because it's kind of the same market. Because look, it's not kind of the same market. It has a different name. If it was the same market, it had the same name. So so even though these crypto markets are kind of correlated, there's nothing to say that one of these times you're going to see one of two of them really take off and have moves, unlike the other ones. And, this is why we call ourselves outlier hunters, because we're really hunting for these outliers, and these trades, like 10% of the trades we do are going to make all the profits. And we got to handle these things correctly, and we can't get out of them too quickly. We got to include them in the portfolio. So we have the most diversification, let's say, than almost any other trader, but we're not wedded to diversification to the extent some people are. We realize that, yes, crude and heating oil can be 90% correlated. Heating oil can double. Crude kind of sits there. Then they go back to being 90% correlated again. And this is what we take advantage of.
That's the answer. David, your turn. There's an ETF that Dan and I manage that gets people exposure to blockchain. No, I'm just teasing. David, go ahead.
I was just going to ask if, so when the risk profile, obviously in the equities changes, is there like an immediate response to the other asset classes? Like, how much is this like trend on an individual basis of the securities, or how much is like the covariance matrix amongst the sleeves and asset classes taken into consideration?
Like, not at all, and only when we set up the portfolio. So when we set the portfolio up 20, 30 years ago, we said, hey, let's not overweight stocks or not overweight commodities, currencies, and interest rates. But there is no rule that says, hey, we're getting mostly stocks now, we're mostly currencies now, so let's cut back on other things. There is no rule like that. Each individual market is treated individually with these trend following rules, and times 300 and some, and then that's the portfolio. So a really bad period, let's say, was COVID, where we were long in most every market, and all the longs went down. And so you're like, wow, I'm glad we have our overall risk budget at a conservative level, because that was a really bad period. Even though within weeks we got short a lot of those markets, and we ended up actually making money, but over that period. But yeah, there is no overlay on top of each one of the portfolio that says, hey, stop following the trends, stop following your system, and now do something because the overall portfolio has changed. We don't want to do that. And if we have our risk under control, we'll be okay. There can be periods, though, where if all hell breaks loose and we see it's something we've never seen before, obviously we would go in and say, oh, well, we just got finished telling everyone we don't want to do this, but we have to do it. We have to make a risk reduction cutback on all the positions. But this should be a rare occurrence.
So, Jerry, how does your day work with this portfolio? And speak a little bit about your team and, the firm itself. I think we've started off with a presumption that everybody knows about the firm. And then I've got a follow-up question.
Yeah, so we, the day goes where at the end of the day, we get the new data and run our systems, and we produce the trades for tomorrow. And so every morning we start adjusting the portfolio slightly, maybe, 4 or 5 trades per day. So it's not a lot of turnover. It can be more than that, or it can be 0 trades. A lot of times when the markets are going really well, for us, there was nothing to do except sit back and watch them go and ride those trends. We've been in business since 1988, and my head of research and the president of our company have been with Chesapeake for over 35 years. So that's good. We have a lot of stability in that regard. We're spread out. We have some people in Virginia, and the world headquarters is in Tampa, where I live. We have people in New York. So with COVID and all of that, we went to a model of mostly working from home and working off-site. So it's pretty easy and pretty efficient model when you only trend follow, and we're not looking to add other strategies and other types of trading, short-term trading or mean reversion or pattern recognition or carry trades. We're just wanting to hone down our strategy, and we haven't really changed the strategy specifically very much over the years. It's really just of executing the same game plan like every day that we've pretty much done for the past 20, 30 years. But we are adding markets. Every now and then we will add a new market, especially with these stocks. When we started going to 150 stocks and 300 markets is something that we have just been doing over the past couple of years.
So just a quick follow-up, and then I'll hand it off to Cynthia. So some of your positions, though, are really, really small. I mean, like 10 basis points, right? What do you hope to accomplish with a position size, that small? Is it just like a tester, and it's something that you're thinking long-term, and you'll add if it goes down another 25% or something?
No, I mean, it's really just a function of trading so many markets and having a base risk level and dividing that risk level into 300, whereas most CTAs may trade 50 or 60. And so mathematically, they're going to be small. And because of the AUM, the risk budget, and then the number of markets. So it makes it very difficult to get uptight about losing money because it's 12 basis points. And if you remember what I said earlier, which is that we expect historically to get about 10 to 15% of the trades to make all of the money. So it's 10 to 15%, whether it's 30 markets or 300 markets. So for me, that's going to mean 30 trades are going to be really big winners on average every year, and they're going to contribute a much smaller amount than if I was trading 30 markets, it would be 3 trades. Both of those portfolios may, on average, make the same amount of money. So it really is just a function of if you're going to trade a classic trend following approach that takes small losses, which is great, but then it's very bumpy and really lets the profits run and lets the open trade profits have a lot of volatility, then the only way to smooth things out really is to trade an inordinate amount of markets. So we can stay true to our robust and our low parameter number of systems, and then offset that with this crazy number of markets, long and short, and always searching for more diversification to offset, the volatility in the portfolio, because when a big trade gets highly volatile, we don't scale it back. We just let it go. And that's the reason we kind of do it, because we believe that people should be tough and strong and hang in there with those profits. But this just makes it a lot easier for clients to handle it and for us to handle it. We sleep so much better than we did in 1984 when I traded 20 markets. It was quite a bit different. But yeah, no, these positions are all sized properly. I know they're kind of small, but we'll be at $1 billion one of these days. And we'll be saying, we need to go find some more markets. We're getting too big.
Can I ask a position question just very quick as a follow-up, and then I'll hand it back to you. I apologize. Is that like position based on the risk of this position or based on your conviction of the position?
No, I have no conviction. My conviction is always the same for every market. It's totally based upon the underlying volatility in that market at the time of entry. So if it's a really volatile market, we trade it small. If it's a really low vol market, like the short-term interest rates, we trade it larger. So we want each trade to be the same bet and give us the same possible juice, the same possible profit potential. And so given there's different risk and volatility in every market, you have to size those markets up or down to make each one of them basically the same. So we want to treat every market the same and give it the same room on the downside and the same potential profit.
I was just going to jump in. I know we have a lot of questions coming up on the chat, Mike. Maybe we start bringing those in. But so as a segue, we throw around a lot the term risk-adjusted returns on everything that we do. So I found it really curious that actually your pinned tweet is your issue with the concept of a risk-adjusted return. You call it deceptive and a cover-up and so I'm just curious about, what is your issue with calling, pursuing risk-adjusted returns?
That's funny. I know you guys are really getting me. You're finding all of my weaknesses, trying to be funny and trying to be rude. Although I will say, if you look closely at that, it's a quote from someone else. And I'm not exactly sure what he fully meant by it, but I guess what I mean by that, and most of my friends on Twitter, they kind of know what I mean, but is that in a trend following approach, you're going to take these small losses and preserve your capital, and but you're going to let these profits run, and it's going to get kind of crazy and hairy, and it's going to be a lot of volatility. And so if you use a traditional measurement, standard deviation, Sharpe ratio, I'm going to get penalized, and people are going to think that it's more risky, basic with the volatility in my big winners. So I'm just trying to get people to see that these measurements that we use for maybe more of a normal distribution of trades, like Sharpe, are not appropriate for a distribution of trades that is non-normal, where basically 10% of the trades are going to make all the money, and we're lopping off that left side of the tail and keeping those losses really small. And we shouldn't be penalized if we make 10% in cocoa, but at one point it was 20%. We had a huge drawdown, and so that's the point I'm trying to make. But I'm surprised more people don't call me out on that. It's kind of funny, I think.
That one really stinks. That you keep talking about cocoa. It's like, that's the one that got away,
No. Cocoa's fine. I'm trying to think of an example. I'm just a little nervous, but no, cocoa will be fine.
Every time he talks about cocoa, the bird is in the background screeching about it. Bird's sick of hearing about cocoa.
Not only do I trade cocoa, and what cocoa is another good thing about trend followers is they should never care about historical performance of an individual market. We can run our back test over 30 or 40 years, and obviously there's going to be one or two markets that didn't make money or didn't do very well. And cocoa is probably one of those. And I think cocoa went, I don't know how many years, 5-10 years, and never had a profit. And we never give up on the market. We never give up at all. And then now it's just been so great. But we talk about it and shake our head about it. But not only do I trade cocoa, I trade two cocos, and London and US. So I've made double the profit, but unfortunately, double the gift back this week as well.
All right, so David, you get one more in, and then let's go to the audience for the last 15, because there's a ton of questions.
Yeah. So if I did my math right, it looks like you're actually like net short equity in the strategy and also net short fixed income through the future side, which I think, people ask, like, what does this do to your portfolio? If you have a 60-40 portfolio, the ability for this thing to, like, on trend, turn that switch off, I think is really, really beneficial, right? Because it's something that is done emotionless within the portfolio. So I commend you on that for sure. I wanted to ask on the short stock list, it's kind of seems like you're going straight at like the dividend aristocrats, like the most boring companies in the world. I don't know if anyone would, agrees after seeing this list, but it's kind of like the stalwarts that everyone would say, these are the companies you can probably hold for 30 years. And I'd love if you could share a little bit of a thesis on that, because I thought that was really interesting. The Coca-Cola's, Kraft's, General Dynamics, Hershey's, Lockheed Martin, Keurig, Kellogg, Discovery, CVS, General Mills, Target. These are the boring companies that are supposed to be, the ETF's public. So we can all talk about this now. But yeah, any logic into that, because I thought that was really interesting.
Right. I love these shorts. I mean, this is just one of my best ideas ever. You can really get a lot of good short exposure, a lot of diversification. Traditionally, CTAs would trade indexes only, and so they're short positions, and the stocks would just be indexes, maybe 20, 30 indexes. And so we have 80 shorts maybe, and on the way to a lot more probably, or possibly at some point in time, But yeah, I think you want to stay away from those really large diversified companies on the upside for the longs. The longs I like to be more smaller companies, one business, outlier potential is pretty high. I don't want diversification from my longs. I'll put my portfolio together and I'll create the diversification, but I don't want some big conglomerate as a long. But as a short, it's pretty good because I can diversify better than shorting indexes. The fees associated with shorting are really low for the big stocks. I can actually borrow the shares, and they're liquid. So that's the reason I do that. I've had some fun, with those. I know I was reading an article 6 months ago about Buffett buying Occidental Petroleum, and then I noticed that Occidental Petroleum was in kind of a downtrend, so I shorted it. I thought that was kind of funny that I was going to see who was going to win on this one, me or Buffett. So I thought I'm totally fine losing 12 basis points because one of these days I'm going to make money on one of his longs. And actually, embarrassingly, one of my first shorts ever was Berkshire Hathaway, and I lost on that as well. So I have no problem being made fun of on some of these shorts, and I really enjoy them though, and I just enjoy following them. But look, the decision is it in the downtrend? Did it make that 100-day low? That's all our computer cares about, and we could care less. We've gotten some really nice ones like Dollar General. That's just a tragedy. But yeah, it's better to short those big companies. The expectation of the profits in those is going to be much better than shorting indices or shorting smaller stocks. It's kind of a technical thing we found in the research as well, besides all the...
Makes total sense. You're getting diversification from the conglomerates and harvesting the randomness from the basket. I know.
Exactly.
Beautiful.
All right, I'm going to start reading some questions from the audience. And then if you want to come up and ask a question, just put a hand up. But I'll start with Warren's because I love, let's get to the brass tacks of things. Warren's basically asking what kind of person or investor needs this ETF? Where does it fit in a portfolio? And this is one of the most important questions, right? Because we just listened for 48 minutes. Nobody's going, man, that guy doesn't know his shit. Everybody's like, wow, right? But you may know all this and be running a great portfolio in an aggregate, but where does it fit in a portfolio for an advisor or an investor?
That's a tough question. I have my opinion on this, but I'm totally fine if people buy the ETF and say, I bought it. I didn't pay any attention to Jerry's reasons at all. I have my own reasons, and I don't agree with his reasons at all. But I do think that it is our attempt to have a better overall portfolio. And I think it is going to help when the stocks crash. We are going to have some short stocks, and then half the portfolio is not stocks. That has tended to be a good thing. The short piece is good, short stocks and shorting commodities. That has helped interest rates and currencies when stocks have done poorly. But really, I think it's someone who says, I love trend following, and I understand trend following. I love this idea of small losses. I love the idea that you can't predict where the markets are going. No one can predict the future. I love this idea of a systematic rules-based approach and a trailing stop and getting in these stocks and getting out with a profit when the trend changes. Buy and hold is great. I love it. It's fantastic. But I can also move some of my equity exposure to this ETF and with a whole different strategy. And it will be quite a bit different, certainly because of the shorts, but even the long piece will be a bit different from the buy and hold, because trend following can fail dramatically in these V bottoms, when the market sells off and then completely rallies, just like COVID. And trend following will not handle that well. And then also trend following will save your butt in some scenarios where that trailing stop and stop losses really help to reduce the positions, get you short, and get out of those longs quicker. So it's a real good complement for the buy and hold portfolio. But, for me, I put all my money in it because I don't want to have a 50% drawdown on any section of my portfolio, an 8% return in stocks with a 50% drawdown. I'm not going to do that. Zero for me in that. But I know that most people are not like that. But you really have to appreciate and fall in love with trend following like I did. And then it becomes just the greatest, most fun thing. And there's no, but I think other people can, live with it for a while, buy a little bit, live with it, get to like it a little bit, and maybe over time add to it. But for me, when I first heard about trend following, I was read in that regard.
I'm gonna simplify that one for you, Jerry, and say it's a non-correlated diversifier. That's what we're gonna put in the marketing material. But yeah, I truly appreciate you going through all that. All right, so there was a question from way early on from Andreas Venter. When optimizing a trend following system, trading a portfolio of markets, do you prefer to optimize a single set of parameters across all markets for a given system, or do you prefer to optimize each individual market in the portfolio trading on a system? Wow, that's a big one.
Yeah, for many reasons, mostly related to proper math, you want to use the same parameters for all the markets. However, we use 4 different sets of parameters over all the markets. So you can do it that way, but you don't want to have an OJ system or a Swiss franc set of parameters or a crude set of parameters. The most robust way of doing it is to use the same set of parameters over all the markets. You can kind of prove that works. But trust me, that's the way to do it.
Okay.
Good. That's good. I think that's a good way of doing it. 50% long short stocks based on trend only, 50% currencies, commodities, interest rates, futures, long and short. Yeah, that's fantastic. I think the way it's really incredibly different is that it's the stock piece, the trend following individual stocks. The CTAs managed futures, they only trade indices. Bad, not a good idea. These single stocks give you so much more diversification, the outlier possibility. And then we let profits run to an extreme degree. We let it run and we don't scale it back as the trade gets more volatile and more scary. And we don't take profits prematurely. So that's another big difference. It's sort of classic, pure trend following, as many different markets as possible. And I would just say, I would not make it 50% stocks if the stocks didn't deserve to be 50%. They deserve to be 50% because there's thousands of them, and I am able to go out there and find 150 that are really not that correlated to each other, or the S&P. And so they act more differently than some of the other sectors sometimes. Like right now, there's lots of diversification in the stocks. There's no diversification in interest rates, really. They're all short, rates everywhere going up. So now on any given day, when the Dow is down 1,000, I may have 1 or 2 winners on my longs. Right. So on a day, a week, or a month, or a period, yeah, they're going to be correlated. So all these other sectors as well, they can have these fundamental shocks to the system where they're all going to send the commodities up or down as well. But stocks this is not just some sort of marketing thing where we say, hey, let's come up with half stocks. Stocks deserve to be half the portfolio because of their diversification qualities. If you get out there and search enough, you'll find some really unique, and just run a chart on all of our stocks. Download the spreadsheet and put it into your chart program and scroll through the stocks that we have. They don't look, there's no such thing as a typical looking stock, and I measure our portfolio performance daily on the S&P, and it's incredibly different usually than what the S&P is doing. Sometimes it's a lot worse. Sometimes it's better.
Thanks. David, why don't we let Brittany go since we're coming towards the top of the hour. I want to make sure everybody gets in.
Kind of on that same subject you just talked about, Jerry, now that Twitter and other social media platforms can influence stock volatility, as demonstrated with things like GameStop that we saw after the pandemic, can you talk a little bit about how trend following generally manages volatile outliers that aren't following the normal trend with the rest of the market?
Well, that's, the most important thing is to not look at any of these markets or any of these stocks as being part of a market or the market. It's one of the most irrelevant questions to ask me would be, what did the market do today? Because I'm like, I hope I've done a really good job of my stocks looking nothing like the market. And so have this mindset initially that it could be a unique situation. You could get an outlier to the upside when the S&P is going in a downtrend and vice versa. And so just having that mentality and willing to treat that stock as an individual, and it's not related to anything else. You don't need to have stocks in general in an upswing to have longs on or to stick with a long. So, and then just treat it like we treat every other market. Every market we trade has the same entry and exit parameter, and they're nothing special, and just let it play out by using those rules that you're committed to. And so really there's nothing to do except follow the rules and follow the system. And but I do hear a lot of, even CTAs will say, yeah, I have this overlay. I'll do my stock trading based upon what the overall market's doing. I want some confirmation. And I think that's the sort of stuff you want to kind of avoid. And in order to, CTAs have a tendency to make money on things that have never happened before. They were dumb enough to stay long interest rates when interest rates were going to zero. They can't go any lower, and they kept going lower. And so a lot of the money that I've made over the years are from things that we've never seen happen in the markets before. And that has worked pretty well for us. So I'm going to keep doing that. Less is more.
No more. Thank you.
Yeah.
Hey, but we got a minute left. So if you can sneak in a question, go ahead, and then we'll wrap up with Jerry here. He's going to talk on mute for a minute.
I was going to ask Warren's question and talk about the Magnificent Seven stocks.
Okay.
Have they been on the long or short side of your book here? Because I know you guys are kind of choosing your universe, or have you kind of just stayed away from them?
You mean the crypto stocks?
No.
Magnificent Seven is that paying plus.
Oh,
yeah.
Right. Yeah. No, they're not in my universe except on the short side because they're too large, too big. And so, one of the funny things that, and this is another CTA thing, is NVIDIA. So I looked at NVIDIA, it's a big stock. And anytime you have a rule, even a good rule, it's going to fail sometimes. And so my whole theory of let's prefer small stocks on the long side, then all of a sudden comes NVIDIA. It's kicking ass, it's going up, it's the stock to own. And one of the things that CTAs do, they do use this volatility measure to size the position. So you have to take the profit in NVIDIA and divide it by the ATR when you put the trade on. And it wasn't that big. It was a pretty volatile stock. And so it wasn't a great, huge outlier. And I was able to find a handful of stocks that made more money for me because of that formula. And one of them was ELF Cosmetics. And so I just posted a chart of ELF and NVIDIA, and they look pretty similar side by side. So That's kind of fun too, to see that you don't have to be in the hot 7 or the top, the ones that are in the news all the time. Just sit back, trade in your group of markets, and you'll get your fair share, your 30% of, or 13%, 10% of the stocks will do pretty well and make your year. So yeah, I have a handful of stocks that have done better than NVIDIA. No one knows about them. So I'm perfectly fine with that.
All right. We're going to wrap up there with Jerry Parker, the only man not long NVIDIA.
And willing to talk about it.
This has been a lot of fun. Different conversation, and that we got to get into some markets that we don't always get to talk about. I've put in the chat the link to the website for Chesapeake's fund through Blueprint. We really appreciate it, and we'll see you next week. Thank you, everybody. The trend is your
Thanks,
friend.
everyone.
We're